to part 3 at the conclusion of our lesson on recording purchases of merchandise using a perpetual inventory system. One thing we haven't mentioned yet is transportation costs. Who will pay the transportation costs of the inventory from the vendor to the purchaser? Will it be Southwest Electronics Depot, or will it be Smart Touch Learning? That will all depend on the purchase agreement. The purchase agreement will specify FOB terms, free on board. And that'll determine, number 1, when title of the goods transfers to the purchaser, and number 2, who pays the freight costs. If the purchase agreement specifies the terms FOB shipping point, that means the buyer takes ownership of the goods after the goods leave the seller's place of business, what we call the shipping point. This also means that usually it's the buyer that pays the freight. So in our example, the vendor, Southwest Electronics Depot, when the goods get delivered into the truck, that's the shipping point. That's when Smart Touch Learning takes ownership of the goods and pays the freight when the goods are delivered to their warehouse. So FOB shipping point usually means the buyer, Smart Touch Learning, pays the shipping costs. On the other hand, if the purchase agreement specifies FOB destination, that means the buyer takes ownership of the goods at the delivery destination point. That also means that usually it's the seller that pays the freight. So in our example, Southwest Electronics Depot, when the merchandise gets delivered into the truck, it's the seller, they're the ones that still own the goods until it gets to the destination. It's also the vendor in this example that pays the shipping costs. So now, only when the goods get to Smart Touch Learning, it's only then that the goods become theirs. So the seller pays the shipping costs when it's FOB destination. The term freight in means the transportation cost to ship the goods to the purchaser's warehouse. Or in other words, freight on purchased goods. So when Smart Touch Learning purchases goods from its vendor, whatever costs they have to pay for shipping, that's considered freight in. On the other side of the coin is freight out. That's the transportation cost to ship goods out of the seller's warehouse and to the customer. Or in other words, it's freight on goods sold. So for Southwest Electronics Depot, if they're the ones paying the shipping costs, then this would be considered freight out to the vendor. So let's assume Smart Touch Learning pays a $60 freight charge on June 3rd for goods purchased from Southwest Electronics. Because it's the buyer paying the freight charge, this implies FOB shipping point. So when the goods are delivered onto the truck to be shipped to Smart Touch Learning, that's the shipping point. That's where Smart Touch Learning takes ownership of the goods, and they also pay for the shipping costs. When they record this journal entry, notice what account they debit. It's the merchandise inventory account. Because when Smart Touch Learning pays the $60 freight charge, that's increasing the cost of the merchandise to get that to Smart Touch Learning. And cash is decreased with a credit in this entry. Let's show you what happens with freight in if the invoice is paid within the discount period. And it's normal business practice that discounts are not computed on the transportation costs. So if it's FOB shipping point, the vendor, in common business practice, sometimes will say, we will prepay the shipping costs and just list the cost on the invoice. So we'll say on June 20th, it's FOB shipping point. The goods are delivered to Smart Touch Learning, and Southwest Electronics sends Smart Touch Learning an invoice showing the cost of the merchandise plus the prepayment of the shipping costs for $5,400. And we will assume credit terms of 3/5 and /30. Now on the shipping date, Smart Touch Learning will record a journal entry increasing inventory and increasing accounts payable by $5,400. The cost of the merchandise plus the freight. But if Smart Touch Learning pays within the discount period, the 3% discount will only be computed on the $5,000 merchandise cost. So if they pay on June 25th, which is within the discount period, notice that merchandise inventory, the 3% discount is only calculated on the $5,000 merchandise cost. So this will be a decrease in the cost of $150. Then Smart Touch Learning will send a check to the vendor, not for the entire $5,400, but they'll subtract out the discount, so they'll pay $5,250, but the entire accounts payable will be wiped out of the debit, $5,400. The last point we would like to get across in this lesson is calculating the cost of inventory purchased. Businesses want to calculate the net cost of inventory purchased because this allows the business to determine the actual cost of merchandise purchased. The way we calculate that is by taking your purchases, subtracting any returns, allowance, or discounts, adding any freight in we may have paid along the way, and that gets us our net cost of inventory purchased. So let's say for Smart Touch Learning, throughout a period of time, they purchased $281,750 of merchandise, but returns and allowances were $61,250. They took advantage of discounts of $4,410. They had to pay freight of $14,700. This will get us the net cost of inventory purchased of $230,970. So this wraps up our three-part lesson on how do we record purchases of merchandise inventory when we use a perpetual inventory system.